We're delighted once again to have Danielle DiMartino Booth, CEO and Chief Strategist at QI Research and a Fed expert to discuss the economy and the Fed decision today. Danielle, welcome. It's great to have you on the show again.
Thank you so much for having me on this big Fed day.
Wow. That was a bit of a surprise, I thought. Now nobody wants to hear me talk about it. Let's hear what do you think? What are your takeaways from what really the Fed decision and what Jay Powell had to say today?
So, I think it was very interesting that the Wall Street Journal published a story at 9:02 p.m. Eastern last night, basically broadcasting to the world to expect the two dissents. By doing so, they were able to distill the effects of the dissent. So I think that was very much intentional on Jay Powell's part.
He knew that he couldn't talk Michelle Bowman out of it, and then sort of put it out in there, so to put it in the expectation, so to speak.
Exactly. Michelle Bowman and Christopher Waller. This is the first time that this has happened in decades. And there was also a change in the language of the statement, a little bit of softening in terms of the outlook for the economy and acknowledgement to the softness that we saw in the GDP report, especially on the business investment side. And that tells me that if Chair Powell already knew that the world knew, because it was in the Wall Street Journal, that there were two dissents coming, that tells me that there was probably another dissent in the ranks, a third.
Austin Goolsbee, maybe?
I would have to think so. Yes, the president of the Chicago Fed does traditionally, historically play the role of the dove, and I can only imagine, that he had to be bound and gagged today to not dissent and have a third dissent, especially because Adriana Kugler was not present at the meeting for personal reasons. So there were just 11 people voting. Once you get 2 out of 11, one thing, 3 out of 11, you're getting statistically significant, which is meaningful to the markets.
It was surprising. I'd actually thought that Bowman perhaps would hold back in the name of Fed independence, but I guess she chose not to, which was interesting.
Well, I think what's more interesting about Michelle Bowman in particular is that last September she dissented the other direction,
right,
against the 50 basis point rate cut that the Fed was kind of forced to push through with, because data subsequent to last July's FOMC meeting showed that the Fed had indeed made a mistake by not cutting in July, and that therefore they had to play catch up. And she dissented against that in a very hawkish way. And yet today was a dovish dissent. Some people are painting that as being political on her part. On the other hand, there is so much in the data, Ty, that there's an undeniability that yet somehow, some way, Powell manages to continue to deny in the data.
It was really interesting that he focused specifically on the unemployment rate on the household survey, 4.1%. That's what we're really looking at. And, that's a rate, it seems that, the folks who read not to be mean about the tabloids, because I do enjoy my tabloids, New York Post, one of my favorite papers, but you would see that that's sort of the everyday person probably looks at is the unemployment rate, and he chose to sort of pick that as the as his anchor, so to speak. It's not the first time he's done it either.
True, and it certainly cannot hurt that the size of the working population of the United States right now, as we well know, is shrinking. So as we stop immigration in its tracks, as there is aggressive deportation going on, as there are mathematical factors that are going to depress the unemployment rate going forward, it's mighty darn convenient that he's going to be leaning on that as opposed to possibly averaging what the last two ADP reports was, which shows that there is a definite slowdown in hiring across the United States. But he just basically put the non-farm payroll figure out, to pasture.
Quite remarkable. What else about the press conference? Some of his answers really stood out to you.
So there was a word, when anybody uses a word that they've never used before, and then they repeat it over and over and over again, that it's wormed its way into their brain. And he continuously said the word efficiently, 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 efficiently. We are going to be efficient in our proceedings. And what that says to me is we're not going to waffle. We're not going to go back and forth and back and forth. We're going to have definitive evidence in hand that inflation is not problematic before we start to cut rates. And around the third or fourth time he said efficient, the S&P 500 went from green to red and kept going as his personal stance and his body language became more and more defensive and more hawkish.
You're right about his body language, and I seem to notice that he wasn't as measured and calm as he had been previously. I wouldn't say jittery, but he was certainly not as measured and calm. And certainly asked some very pointed questions. I'd have to give it to him. He's been, I thought, as far as his presentation, I think a very good Fed chair. Except I think for his first or second press conference, it was a little too forthcoming, and the market panicked. I think he learned his lesson.
He did learn his lesson, but he also lost his temper.
Right.
In the end, bear in mind, it felt like just looking from the outside in, you started to feel this kind of snowball effect, and that there was just too much tension building. And again, I think in a different world, I was out of the country, and the foreign media really made a caricature of the public berating and the hard hats. And it was carried in such a derisive way in the international media that would grate on anybody. Absolutely. It's no fun to be publicly humiliated and berated. And Jay Powell is an intelligent person. So you can tell that the bullying has gotten under his skin. And he wanted nothing from the press today when it came to talking about fiscal policy, government policy, the effect of the administration on his deliberations. Just the more questions he was asked to that effect, the harder he pushed back.
So I noticed that the Fed funds futures, and they may or may not be the best indicator of what the market expects. They priced, the last time I looked, just before our conversation, they were priced at 50-50 for a September rate cut, and I think it was 65-35 at one point, a couple of days ago. So that's a pretty big change. All else being, and I think he was actually asked that question, he declined to answer it. All else being equal, if we had sort of payrolls on expectations and PC on expectations, and we wind the clock forward into mid-September, does the Fed cut if all else being equal?
It certainly sounds like the Fed's not going to cut if the unemployment rate doesn't move. And we know that there are certain elements of PCE that have kind of a built-in bump that will then dissipate, but that won't matter. And he did say there's a lot of data that's coming out between now and when we meet on September the 17th and the next time I'm up at the podium. And if the data is not convincing between now and then, and I think by data, we can now boil that down to, as you rightly point out, Ty, the unemployment rate, I don't think they move in September. And again, there's going to be more and more pressure from the administration to do so. For heaven's sake, Trump came out and said, we need to lower by 300 basis points. Again, right now, I think the public beratement is highly counterproductive to the real U.S. economy.
You're absolutely right. And if we were to have a president who wasn't so ready on Truth Social, I must update that website 15 times a day just to make sure I don't miss anything. If it wasn't for that, perhaps, he would have given a 25 basis point cut, this time, but it almost feels like it's more now about Fed independence, that if he had cut today, it may have been counterproductive, as in the pressure worked on the Fed, which is ultimately in the long term, you don't want to see.
You don't want to see it, because the longer the Fed delays, the bigger the price that they're going to have to pay in terms of being reactionary to the data and reactionary to the data after the fact. And he is clearly disregarding the fact that 40% of Americans have exhausted their unemployment benefits. So you can say that the labor market is solid, but try telling that to the 40% of Americans who've run through their unemployment benefits after a 26-week period and now don't have any income to speak of at all. It is extremely denigrating and insulting to the American public to continue to maintain that the labor market is solid.
I think I saw you did you spoke on TV the other day. I think you said that that there was an Uber driver that that your mom would take from her home to the airport. Is they're only getting half of what they used to get. I mean, we surely don't see that in New York City, but could you expand a little bit on that? Is that really, that what is that telling us about, the gig economy?
It's telling us that the gig economy is like a gas tank that you can't put another drop of gasoline into. You have saturated that labor pool with individuals who are looking to augment their income in some way. And that is this in its most simple form. It is the law of supply and demand. If there are more drivers out there, if there are more individuals working in the gig economy, you have to pay less for every one of them because their value decreases as their supply increases.
So essentially, more and more people are driving Ubers and Lyfts, and at least in some parts of the country, not in a place like New York where everything's expensive, the prices have dropped dramatically. That's a sort of a really telling anecdote of what you're seeing. I wanted to mention you wrote a tremendous, lengthy piece on Marina Eccles today, and I'm gonna try to share if I can, and there he is, right next to Jay Powell.
I mean, there he is.
I have to say there is some similarity, and so Marina Eccles was the Federal Reserve Bank building is named after him, as you rightly point out, and he stood by his guns against President Truman. And as a matter of fact, I think you mentioned in the article that he stayed on as governor after his post ended as Fed chair because he didn't really like what the Truman administration and the Treasury were trying to do with monetary policy. So a great piece. So what do you think the chances of Powell, given this public berating that he's gotten? Do you think he might just say, you know what, I'm going to be chairman emeritus, like Pope emeritus, and I'm going to stick around, after my term as governor? What do you, as Fed chair, what do you think of that?
So I think the odds are exceedingly low, ... today. But I think the worse the situation gets between the president and Chair Powell, I think the higher the odds that he does something along those lines to try and protect the sanctity of the Federal Reserve, which happens to be ironic because he's not making policy correctly right now. But in order to protect the Fed's independence, and it seems to be increasingly that the president wants to bring on, for lack of a better term, a patsy, somebody who's going to do his bidding. And if Jay Powell staying in his post is the only way to prevent that, then he might go that route, which would leave the president with one position to fill in January when Adriana Kugler's term does end as a governor and she is required to leave. So that might mean that if he wants to bring in somebody from the outside, his one and done shot comes this January, if Powell should decide to stay on. And again, the Supreme Court has indemnified the positions of Fed leadership, and Powell has every right to finish out his term and remain on the board of governors through the end of January 2028.
One of the things that you mentioned in your article was about a peg, and it seemed like it was how the Fed at that time were at some point supporting Treasury prices, and we have, from time to time, people write that at some point the Fed is just going to come in to buy bonds as a buyer of last resort and maybe peg the yield curve at some point if rates get too high. Is that a real possibility, or is that really sort of really like the doomsayer saying folks who say, who always say that you have to buy gold, you have to buy all these things because, the debt is completely out of control. And certainly it is unsustainable on an unsustainable path. But so far, it seems to be okay.
It does. And that just gets you back to this idea of relativity with other countries whose fiscal houses are in worse order than that of the United States and who don't have the benefit of having the reserve currency status. I do think one thing that I should point out is that the central clearing of treasuries is very much still alive. And in fact, Powell mentioned in his most recent congressional testimony, and that is something that would protect the trading of the risk-free asset in the event of future market disruption, ensuring that any and all trades in the Treasury market were cleared. So I think you would have to have a radical moment, if you will, kind of a crisis of some kind to bring about the change that you describe, or again, installing somebody to take over as Fed chair who could convince the entire committee to completely give up all independence in the name of acquiescing to the administration. I don't think the odds of that are very high. And I think that's one of the reasons that Treasury Secretary Scott Bessent has been such a voice of calm of late, because he recognizes that one man does not make a committee, one woman does not make a committee, and that even if there's one person on the Federal Open Market Committee, that one person can easily be outvoted.
Right. Especially if they were considered to be sort of, at least in the beginning, a tool of the political.
Sure, a puppet.
Right.
A puppet Fed chair.
I just want to go a little bit further than that. There's been a lot of writing about sort of de-dollarization, people moving away from U.S. assets, particularly for a long time. Every time every dip, you had to buy U.S. bonds, and even as the Fed started cutting the 30-year bond, and when they started cutting last year, the 30-year bond yield is higher now, and so is the 7-year bond yield, which is roughly, I think, the average duration of where we borrow. Both those are higher now, and the Fed has been cutting. Is that an indication that the market, certainly the international market, global investors, have lost confidence in the U.S., or is this a little bit of a tantrum that eventually they're going to say, well, we're going to need real return on our investments, and there aren't too many other bond markets to buy into?
Well, and that gets to the crux of the issue, right? Germany unexpectedly reported that it fell back into recession, that its economy contracted. Other central banks are going to be forced to continue cutting rates, making, relatively speaking, U.S. Treasury rates that much more attractive. That's the true test. And I think another element of what we're witnessing is positioning. It's simply positioning by the biggest players in the Treasury market who benefit let me be precise here, who profit if yields rise.
Now, in terms of just switching gears a little bit, I've read a lot in the Daily Feather about how businesses are holding back and not investing. Daily Feather obviously is your daily, in case someone.
Yes, it is.
Not everybody who listens to us reads your daily, but perhaps they should. Is what it's going to take to make businesses invest again? A resolution to the tariffs? I mean, it seems like we're halfway there. We got Japan done, we got the EU done, India is haggling, but we're sort of halfway through the process. So what is it going to take for them to say, the big beautiful bill, I think, gives them some really nice write-offs for investment. What is going to turn the thinking of corporate America so they expand, and then private hiring, that virtuous cycle.
That virtuous cycle. Oh, exactly. And that's a really good question, because we saw business non-residential fixed investment was negative 3%, 3.0% in the fourth quarter of 2024. That boomeranged up to a positive 10.3% in the first quarter as there was this massive tariff front running. And then it fell off a cliff to 1.9% in the second quarter. So to answer your question, I think that the beginning of trade success is an essential step one, but I think that the individuals who are the CEOs and CFOs in corporate America are going to need to see some follow through. They're going to need to see the investments that have been promised to the administration come to fruition. There's $1 trillion between Japan and the EU alone that have been committed. But I think we're going to need to see actions back up words and to see some more meat on the bones of these trade agreements rather than Truth Social posts saying how awesome they are. I think that the level of uncertainty has dissipated to a certain extent because there have been headlines and there's obviously been some progress, but I don't think that that is going to spur CEOs to act on the easier way to depreciate assets going forward, to act on the fact that their taxes are not going to increase at the end of 2025, to get off the front page of the Wall Street Journal where they're bragging about how many people they can fire as some kind of badge of honor. We're going to have to shift that. And that's going to have to do a full 180. And I think in order to get there, and I think the word uncertainty has been beaten to death. But I think that there's going to have to, rather than say the uncertainty is lifting, I think we're going to have to see some follow through.
So this sounds like probably not even a Q4 25. This is a Q1 26. This is probably next year before enough time passes that these investments can come to fruition. Maybe we get a China deal at some stage later this year that's acceptable to everyone. Feels like the rest of 2025 may be a bit bumpy.
I think that volatility is definitely the name of the game. A lot of us have very short memories. Some of us don't. Some of us recall the fact that even after the trade deal with China was signed in January of 2020, that there was not follow through. And right. So there is reason for skepticism, even if deals are signed.
So we still have PCE data and employment data for the Fed, since it is really Fed day. Is it PCE? I guess it is. Have they basically told us it's the unemployment rate? Is it nothing else but the unemployment rate that's really going to really matter for September?
Well, that's what bond traders are going to say, because they're going to listen to what Powell said. And again, until he visibly loses complete control of his committee, and we will know pretty soon because non-farm payroll Friday is upon us. And we're at the cusp of 2 million in continuing claims. At some point, he could be risking mutiny if the data other than this sacrosanct, this newly blessed unemployment rate, at some point, he's going to start to lose the confidence of others beyond Michelle Bowman and Christopher Waller, who are seen as potentially being political, trying to curry favor with the president if the data continue to deteriorate.
We might become the Bank of England, which seems to have, I think, 5-4 votes and 7-4 votes, or votes right. Are actually very, very close.
Well, and I think you just said that 2025 might be bumpy, because in an environment like that, the bumps are going to get a lot bigger.
Yeah, I do have one last question before, and I've taken a lot of your time. I look at ADP and then I look at the payrolls and I try to pair the two, and it's really just, they don't seem to correlate. We've got a strong ADP now. It wouldn't surprise me if we have a weak payrolls. It's sort of sometimes how do you look at these two indicators, and which one do you trust more?
I trust ADP more because in the final analysis, it is a pure prism into the private sector. And we just got major revisions to payrolls for the fourth quarter of 2024 today. Again,
what did those look like, if I might ask?
Payrolls were worse than we had expected. Right now, in the year ended the first quarter 2025, actual payrolls are running at 32,000 a month on average over the last 12 months.
So last 12 months
backward revisions in hand.
Through the first quarter.
The year ended March 31st, 2025.
Wow. Only 32,000 a month, which doesn't seem like a lot.
And again, this is 12 million American companies correcting the imputed numbers that the BLS reports.
Wow.
So this is the hardest of the hard data.
And we need, I think the number is 100,000 a month to maintain the growth of the with the population growth. Although that's a little bit different now, given what we've had happen this year. But 32,000 seems like a very slim number. So the ADP is what is what we actually.
I think the ADP is a more real-time, realistic metric, because once we get revisions in hand, we come to find out, okay, maybe ADP wasn't so far off. After all, of course, traders trade based on what's announced the morning of non-farm payroll Friday. That's right. How traders trade. Trade the narrative, own the truth. That's my mantra. You know that.
Yes.
But looking back, we know that there were net job losses in the 6 months ended September of 2024. Net job losses for 6 months. That's a recession. And that's hard data.
Danielle, thank you so much for joining us today and giving us the real time sort of story on the Fed. And we look forward to having you on the show again very soon.